Let's play a quick game. Picture the kind of house you imagined owning when you were younger. Maybe it had a proper backyard, a garage, enough bedrooms that guests didn't have to sleep on a pull-out couch. Nothing extravagant, just a reasonable, solid, ordinary home in a neighborhood where jobs exist and schools function. Now here's the question nobody in the real estate industry wants you to ask out loud. What if that completely ordinary house costs $500,000 in 2026, and the math to actually own it, not just get approved for it, but genuinely own it without it slowly dismantling your financial life, requires an income that roughly 9 out of 10 American households simply don't have? Because that's not a hypothetical. That's Tuesday. And once you see the full arithmetic clearly, the entire cultural story we've been told about homeownership starts looking less like wisdom and more like a script written by people who profit from your participation in it. Start with the price, because the price is where most people's understanding of the problem begins and unfortunately also ends. $500,000 sounds like a specific, possibly avoidable number, as though buyers who can't afford it just need to shop in a lower bracket. But in 2026, in virtually any American metro area where employment actually concentrates, where the companies are, where the career opportunities live, where the infrastructure functions at a modern standard, $500,000 is not a luxury number, it is the floor. It is what you pay for the house that needs the kitchen updated, sits on the edge of the school district boundary, and has a commute that turns a 20-minute drive into 45 minutes during peak hours. In cities like Austin, Nashville, Denver, Seattle, Miami, or anywhere within reasonable distance of a major employer, $500,000 is the entry ticket to home ownership, not the upgrade package. That reframing matters enormously, because the moment you accept it, the question shifts from why can't people just buy something cheaper to who in this country can actually afford the cheapest available option in a functional market. The answer to that question requires building the real monthly cost from scratch, because the number most buyers focus on, the mortgage payment, is the least complete version of what they're actually agreeing to pay. Walk through it methodically. A buyer purchasing a $500,000 home with a 10% down payment is borrowing $450,000. At current 2026 interest rates, sitting in the 6.5 to 7% range, that 30-year fixed mortgage produces a monthly principal and interest payment of approximately $2,850 to $2,980. Already a significant commitment. But that's where the advertised payment stops and the real cost begins. Property taxes on a $500,000 home vary by state and county, but nationally average somewhere between $5,000 and $8,000 annually. Call it $500 to $665 monthly. Homeowners insurance, which has been repriced dramatically upward across most of the country as insurers recalibrate for climate-related risk, now runs $200 to $400 monthly, depending on location, with coastal and weather-exposed states sitting considerably higher. Because this buyer put down 10% rather than 20%, the lender requires private mortgage insurance, an additional $175 to $375 monthly until equity crosses the threshold. And then there is the cost that every homeownership guide mentions, and almost every first-time buyer mentally files under future problem until the first major repair arrives uninvited: maintenance. Financial planners consistently recommend budgeting 1% of a home's value annually for upkeep, repairs, and system replacements. On a $500,000 property, that is $5,000 a year, or $417 every single month, set aside for the water heater that quits, the roof that develops ambitions of its own, the HVAC unit that chooses February to stop functioning. Combine every honest line item and the true monthly cost of owning a $500,000 home in 2026 lands somewhere between $4,142 and $4,837. Use $4,500 as a working midpoint. Now, apply the standard 28% rule, the widely accepted guideline that housing costs should not exceed 28% of gross monthly income, and work backwards. To keep $4,500 in monthly housing costs within that boundary, a household needs gross monthly income of approximately $16,070. Annualized, that is just over $192,000 in household earnings before taxes. The median household income in America in 2026 sits somewhere between $80,000 and $86,000. The income required to responsibly carry the median entry-level home in most functional job markets is more than double what the median American household actually earns. That is not a gap you close by skipping vacations. That is a structural canyon. Now make it human. Take a household that by every reasonable cultural measure has done everything correctly. 2 working adults. One is a registered nurse with 7 years of experience. The other manages operations for a regional logistics company. Combined, they earn $148,000 a year, placing them comfortably within the top quarter of American earners. They have good credit, they've been saving for 3 years, they're not reckless with money. By the standards of the story most of us grew up hearing, these people have earned their place at the homeownership table. Watch what happens when they sit down. Their $148,000 gross income after federal and state taxes, FICA contributions, and health insurance premiums arrives in their bank accounts as somewhere between $92,000 and $100,000 annually, roughly $8,000 to $8,300 monthly in actual spendable money. That is the true financial container within which their lives operate. Housing at $4,500 monthly consumes 54 to 56% of their real take-home pay before they've purchased a single grocery item. What remains is approximately $3,700 to $3,800 to fund the entirety of their lives. 2 car payments at current vehicle prices run $750 to $1,000. Insurance for both vehicles adds $250 to $350. Student loan obligations for 2 college graduates, modest by 2026 standards, require $600 to $800. Groceries for 2 adults run $650 to $850. Utilities across a full home add $350 to $500. Basic out-of-pocket healthcare costs beyond employer coverage average $350 to $450 monthly. After those categories, none of which are optional, none of which represent extravagance, this household in the top quarter of American earnings has between $0 and $300 remaining each month. Not for retirement contributions beyond the minimum their employers match, not for the emergency fund that financial advisors unanimously identify as non-negotiable, not for the furnishings the house requires, not for the car repair, the medical bill, or the broken appliance that will materialize within the first 18 months of ownership with the reliable punctuality of an unwelcome relative. $0 to $300 monthly in a household earning nearly $150,000 a year, owning a $500,000 starter home. That outcome deserves to be named clearly. That household would be house poor. And house poor is one of the most quietly destructive financial conditions a person can inhabit, precisely because it wears the appearance of success. The house exists, the address is real, the equity is technically accumulating on paper, but the daily experience is one of relentless financial compression. Every decision filtered through the question of whether the mortgage gets covered, every unexpected expense becoming a small emergency, every month ending with the vague awareness that one disrupted paycheck separates the household from genuine crisis. The pride of ownership and the anxiety of financial tightness coexist in the same space, and over months and years, the anxiety tends to win the war of attrition. Here's the mechanism that makes this trap particularly effective at catching people who should, by every reasonable measure, know better. The bank will approve that household for the loan. Lenders qualify borrowers based on debt-to-income ratios that look at gross income and minimum debt payments, a calculation that deliberately excludes maintenance, accounts for taxes and insurance only at a minimum estimate, and ignores the accumulated friction of a fully lived financial life. The approval number the lender produces is not a recommendation. It is not a number calibrated to your financial health or your long-term stability. It is the maximum the institution has calculated it can collect from you while maintaining an acceptable probability of repayment. Treating bank approval as financial permission is one of the most expensive misunderstandings in modern personal finance. But if the math is this unforgiving, how are transactions still closing? How is inventory moving? The answer reveals something important about who is actually buying homes in 2026 and through what mechanisms. A genuine segment of buyers have the income to support these purchases sustainably. Households with combined earnings above $180,000, individuals in established high-compensation careers, buyers whose industry or skill set places them in a compensation tier that the median conversation simply doesn't reach. Another significant segment involves wealth transfer that never appears in income statistics. Parental gifts covering down payments, inheritance distributions arriving at strategically convenient moments, equity from a previous property sale in a market that appreciated substantially over the past decade. These transfers are real, they're common, and they're completely invisible in any conversation that frames home ownership as a product of individual earning and saving behavior. And then there is a third category, buyers who are simply stretching beyond what responsible guidance endorses, betting on future salary growth, accepting financial fragility as temporary, or simply deciding that the emotional value of ownership justifies the mathematical risk. Some of those bets pay off. Many of them produce years of quiet financial suffering that doesn't make it into the cultural narrative about the wisdom of buying property. The down payment problem deserves its own moment in this conversation because it has fundamentally altered the timeline of American life in ways that rarely get discussed honestly. Accumulating $50,000 for a 10% down payment while simultaneously paying 2026 rental rates in any city where employment exists, rates that in most major markets run between $1,800 and $3,200 monthly for a basic two-bedroom, takes the average household earning $85,000 to $100,000 approximately 8 to 13 years of consistent, disciplined saving with no significant financial setbacks along the way. Reaching $100,000 for the 20% threshold that eliminates mortgage insurance extends that timeline further. This means for a substantial portion of the working population, first-time home ownership has been quietly relocated from a milestone achievable in one's late 20s or early 30s to one that realistically arrives, if it arrives, in the late 30s or 40s. The downstream effects of that shift cascade across everything: delayed family formation, compressed retirement savings windows, widening wealth gaps between people who received intergenerational assistance and those who didn't. These are not minor personal inconveniences. They are structural alterations to the shape of financial life for an entire generation, and they deserve acknowledgement more direct than the vague assurances that the market always corrects. There's also a psychological dimension to this that the numbers alone don't fully capture. The story of home ownership in American culture runs deep. It is entangled with identity, with adulthood, with the tangible evidence of having built something real. When the math stops working, the emotional pressure doesn't automatically recalibrate. It persists, And that gap between what the culture says owning a home means and what the arithmetic actually allows creates a particular kind of distress, one where people feel personally inadequate for failing to clear a bar that has been structurally raised beyond reach for most incomes. The person staring at the mortgage calculator at midnight isn't failing because they lack discipline or ambition. They're encountering a price-to-income ratio that has no historical precedent in American housing markets, in a cultural environment that hasn't updated its messaging to reflect that reality. The shame belongs to the situation, not to the person inside it. So, what does responsible navigation actually look like in 2026? It starts with a different question than the one most buyers begin with. Not what will the bank approve, but what monthly housing total, including taxes, insurance, mortgage insurance, and an honest maintenance reserve, can this household carry while still funding retirement meaningfully, maintaining a genuine emergency buffer, and preserving enough margin that a single financial disruption does not require debt? Answering that question honestly and working backward to a purchase price will, in most major markets, produce a number below what's available. That information is uncomfortable. It is also valuable in a way that no amount of financial optimism can substitute for. Renting strategically while building genuine savings is not a consolation prize. Choosing a less expensive geography is not surrendering the dream. Waiting until the household income genuinely supports the purchase is not falling behind. It is the only path to home ownership that doesn't gradually hollow out the financial life it was supposed to build. The house that fits the math will always serve the household better than the house that fits the feeling. The housing market in 2026 is not cruel by accident. It is the predictable outcome of decades of policy decisions, supply constraints, investor activity, and wage stagnation interacting in a system where almost no participant with power has financial incentive to make ownership more accessible. Understanding that clearly doesn't solve the problem, but it does something equally important. It removes the misplaced personal failure from a structural reality, and it gives you the mental clarity to make decisions based on your actual numbers rather than on cultural pressure designed by people who profit from your urgency. Run the full math, sit with what it shows, then build the life your real financial picture can genuinely sustain. That's not pessimism. That's the only foundation worth building on.